Hi, Matan. Thank you so much for coming to the Investor Talk series. How's it going?
It's all good. Thank you for having me. I appreciate the invite.
Thanks to you for your time and spending these 30 minutes roughly to talk about how investing startup. Um, I do the Investor Talk just to open an eye for founders. Actually, how investors think, what's the mind behind investments, right? So they get more prepared when, especially these seed, pre-seed guys, when they start searching for money and approaching the venture capital, actually they have no idea how it works. So this is why I try to help them in this way. As we start, would you like to give an intro to yourself?
Sure. So, my name is Matan Hazanov. I'm a lifelong entrepreneur, and my only real job, and first real job, I should say, has been in venture capital investing in startups. So, my whole life, my whole world is being around entrepreneurs and startups. In my own life, it's been working for family businesses or starting my own business. And then as a career, it's been investing in other people's businesses. Currently, I'm the managing director of Verstra Ventures, which is a Toronto based early stage VC firm focused on investing in vertically focused software businesses.
So your focus is software. Well, when it comes to the sector and the geography and the stage, where would you like to invest? Would you prefer to invest?
We're, yeah, we invest worldwide, but historically we've invested mostly in North America. We've done one investment in South America, one in the UK, and one in Israel. So we're pretty broad, we're pretty open. So long as language and culture isn't too much of a barrier, we can invest anywhere.
In terms of stage?
We invest any. I don't like looking at stages in terms of letters and numbers and all that stuff because I think there's somewhat of a nebulous definition for them, anyways. I've seen like seed stage companies raising $100 million and Series A companies with no revenue. So I don't even know how we decide what's what. But for us, what we do, the early stage we typically invest is when a company has a couple 100,000 in ARR, annual recurring revenues, and up from there.
Okay. So already generating some revenues.
Yeah, and for us, we like to see the product is in the market, it's working, we can speak to customers. Over the last couple of years, we've only invested in companies with over $1 million in ARR. Doesn't mean we wouldn't do something earlier stage, but the last couple of years, we've gone a little bit more later stage.
In terms of ticket, what's the average?
1 to 3 million is where we're comfortable. We don't really have a limit below or above, but we that's historically we've done 1 to 3.
I mean, it's very interesting for me to ask the investors actually what they're looking for when they invest, because some of them are more focused, especially when it comes to the very early stage, to the team, where probably is everything because nothing's there. And when you move more further, is the market, is the product, and how if there is any fit into the market. How do you base your thesis when it comes to investments?
It's a great question, and one I get asked from founders quite a lot, especially those that have been struggling to raise venture capital for a while. The first thing is kind of an orientation, which I think is pretty simple, and everybody can put their mindset in the same mindset, which is what would you need to do in order to invest in a startup? Walk yourself through your own mindset. If you're investing your family's life savings into a business, what would you ask? So that's the kind of orientation I think investors should have, certainly the kind of orientation I have. So if you're curious what investors look for, the first thing you should ask yourself is if somebody came to me and pitched their business and they asked me for my grandmother's life savings, for example, what kind of things that I need to figure out in order to be comfortable with that investment? And I don't suggest anybody ever do that, but that's the kind of mindset an investor should have. And the type of things you think about yourself is very common sense. You want to know, are these the right people to build this business? Do they have the right experience? Do they have the right insight, the right network, whatever? Is it the right market? Is it big enough? Can you build a multi-billion-dollar business in this market with some reasonable assumptions? Are they doing something that's innovative or has barriers to entry? Can someone just replicate them with a little bit of money and a little bit of time? You want to know that they actually that the product fits the problem that they're solving. So not only does the problem has to be significant, but the problem being the way they solve the problem has to fit very well. And you go through each one of these steps. There's a couple more, But you go through each one of these steps and you kind of develop a picture of what most investors are looking for. And of course, at each stage, in each industry, in each geography, there's going to be nuances and variances to that. Like, if you're developing a bio company, it's going to be very different than if you're looking to raise money for a software business or a consumer product. They're just very different. But the elements, the core elements of what people look for in a good investment stay relatively the same.
I mean, in terms of we come before the pandemic was pretty, let's say, not common to invest fully remotely from the beginning to the end, deploy the money without even see the funders in real. Now it's pretty common. I've been talking to many funders, especially in the US. They're very confident to invest, even in Europe, to invest in Canada, to invest completely without never meeting the funders. How do you feel? Do you invest in funders fully remotely?
Yeah, so before the COVID related restrictions, I could not have pictured investing in a business without meeting the management team. That would have been like meeting them in person. That would have been crazy. But basically, every company we've invested in outside of Canada or Toronto, I should be more specific, I don't think we've met the founding team in person before making the investment. And it's a bit of a shock to me because it's just the way you have to do business for like a year and a half. But and I'm comfortable with it much more comfortable with it. So it's actually a lot easier to do deals. And that just means you have to spend a lot more time with them, talking to them. You're taking a little bit more risk when you're not, feeling people out in person. But I think a lot of that could be mitigated by just doing very good research and speaking a lot with them, even virtually.
After investing, do you have a monthly report? How do you get along with the founders? Make sure that things are going right.
Well, hopefully you're developing that relationship as soon as you meet with them, before you're making the investment. The best relationships I've developed is one, well, we're only really investing in people we really enjoy spending time with and speaking with, and we have trust and confidence in them. You don't get to the investment unless all of that is kind of there already in a significant way. But after you invest, I've had in my career a couple of cases where people obviously change. It's like, they're presenting a certain picture when they're pitching to you. But when things get tough is really when you see, and generally everything is good until things get tough. When you have to start making difficult decisions, when you have to, you're right, that's when you really see people like you can go for a couple of years on someone's board and everything's great. The relationship is good. They're reporting, effectively, and you have no concerns. And then once things don't go that way, that's when you start to see real personalities. And in most cases, it hasn't been a problem. But I have a couple of stories where it's been very challenging.
I mean, as we say, the real, not only founder, there are people you see when the tough time comes. When everything's nice, everything's fine, and we are all friends.
Yeah,
That's the reality. But how do you give them your support, except for money?
well, money is. Does there need to be more than money?
Some
I'm
funders
joking.
ask, for example, for introduction to the next round. Some of them ask for kind of advice. Me,
Yeah,
there is
of
this
course. I'm
common
joking.
saying, hands-on venture capitalist. So, what's your take here?
I'll preface what I say. I think we do add a lot of value, but I'm going to preface my answer with, I think most VCs that say they add value don't. It's very challenging to add value. I'm saying that because I've tried it. I've done it. I've been involved in quite several companies. It's very challenging to add value beyond the typical helping make connections and giving advice and all that. So everyone does that. So not that's good. The real kind of value that VCs should be adding that's a little bit more challenging is really helping them with the next raise, right? Being able to have that kind of network and helping out with that process because it's very time consuming, and also helping them with an exit and helping them with connections to real customers and real partners and all that. So that's kind of the same value. We do a little bit something a little bit different because of where our money comes from. I can't really get into in this kind of setting, but we actually in a lot before we invest, we do a lot of work to see if we can actually bring real like connections to customers and things like that. So we actually, in a lot of cases, we even help them get sales. So That's the kind of value I really like to add. Doesn't mean in most cases we can't add that, but in a lot of cases we do. And in my opinion, that's one of the best things you could do as an investor.
Indeed, I mean, I think opening a sales channel even better than introducing to new investors, because in the end of the day, they need to sell one day. They need to start selling and generating revenues. Do you lead invest?
By the way, I think with my answer, I just made an enemy of all VCs out there, but I love everyone. Don't worry about it.
No problem. Do you lead?
Yeah, we love leading rounds. I think it's one of the, we're very confident when we do our diligence, so we can price around, we can develop the structure of the deal, and of course bring other people into our syndicate, other VCs, of course. So we were very comfortable leading, but we've also co-led, we've followed other credible VCs as well.
I mean, I've been talking to a few VC that they try to match their portfolio for sales, for help, and so on and so forth. Do you do something similar? So for you, do you try to have some kind of interaction between your funders?
Yeah, that's also challenging, but it's something we strive to do. We've done it a couple of times. Um, and usually that's we do on our team, we find where there are potential ways for them to connect and bring value to one another. And then we make those connections and we do whatever we can to make sure both parties are incentivized to at least explore that. And we've done events, with our companies. And of course, the other major thing we do is really help them with that other value out of connecting to channels to actually get more revenue. And sometimes that comes from other businesses in our portfolio, but often it's not.
I mean, there is this ultimate rule in venture capital where one or two founders, startups must pay for the entire fund plus the money given back to their P. Is something that works for you as well, or you are not just looking for unicorns?
Yeah, we're not unicorn hunters per se. So I would say we have a bit of a different model. We actually expect a lot of the companies that don't succeed to not be as bad as most VCs, and there's a reason for that. We actually have partners that could buy most businesses we invest in if things don't go, or at least they can bid. They can make an offer to buy the company in a lot of cases. So for us, the model is a little bit different. We're not unicorn hunting because we're also investing in vertical markets. So there's just the exit values can be a bit smaller. But ultimately, I think that the same dynamics work out as well, meaning that you're going to have a few companies paying for a lot of the companies that don't succeed. And that's just the nature of the high risk venture model. So it usually operates on a power law, right? Where 20% will make up for the other 80 usually. But for us, it's just the ones that don't make any money are much fewer, and the ones that make huge returns are also going to be much lower. So it's going to equal out to most other VCs on a portfolio level.
I mean, can you give any advice to funders? I know it's very, very complicated knowing when time to pivot arrives. It's so complicated. But there is some kind of reluctance to accept that you were wrong, because if you're pivoting, something was wrong, and to change. And many times, funders, they change completely. There are very good startups that actually became famous and successful with its own, not even the first product. So what's your take on pivoting? How founders should understand it's time to pivot before it's failing?
Yeah, that if I had the right answer to that question, I would be a lot wealthier. Because we've been involved in a couple of situations like this, I have some experience in
Yeah.
what at what point. It's really hard to say at what point because there's a lot of elements and a lot of factors that go into it, right? The first thing you have to figure out is the desire of the management team. It's of the founders themselves, because you can tell them, "Hey, you need to pivot," but if they're not going to do it, if it's an early stage company, you're kind of stuck with how they want to see their business develop from that point on. So let's assume that they're on the same page as you. Hey, something needs to change. Then that's usually coming from a place of a lack of success, right? So you're running out of cash. You're not finding the right product market fit. There's just some external trigger that's saying something has to change. Very rarely have I seen a pivot where everything's going well, right? Like, why would, if something's going well, you don't change anything, right? So there's some external triggering event, like usually you're running out of cash, that forces you to rethink your business, and it happens quite frequently. I think maybe a quarter to a third of the companies we see, by the time we see them, if they're a little bit later stage, they've done at least one pivot.
Yeah.
Like it's so natural, and it's kind of expected. So I wouldn't be scared to do it, especially if you're early enough. If you see things aren't going well, you're not finding customers, picking up your product. I think that requires a lot of soul searching and maybe a pivot.
I mean, let's say you have three startups pretty much the same, very much the same. The founders team is very strong, product is strong, the market is there and ready to scale. But you can invest in only one of them. I mean, which actually is the factor that is going to change dynamics, deciding you to invest.
They're all the same revenues, same metrics,
I mean,
everything.
almost the same. Let's say they are pretty much equivalent.
Yeah, it's a good one. I mean, for us, it would be the industry they're in. I think industry makes a pretty big difference, not necessarily market size, because let's just say that's all the same,
Mhm.
right? It's really the industry. Some industries are just better to be invested in, especially with all the technology, the AI disruption that's having. Industries where there's a lot of regulatory capture, or regulatory capture may be the wrong way to put it, but industries where there's a barrier because of a lot of regulation. So healthcare, financial services, these kinds of industries are always going to be a laggard when it comes to these disruptive innovations, because the incumbents in those spaces are there. They've had to have gone through many hoops that have nothing to do, almost nothing to do with technology, right? They're business, things that happen with time and money. So those are the kinds of industries I like, because once you're far enough along in the state, the business, the business is more mature. It's a much more protectable business at that point. Of course, it's a double-edged sword, because to get in is going to be much more expensive. So I would take first industry would be one. Obviously, how the relationship with the founders, which is always going to be different. Those that you have a nicer feeling from, assume they all have the same amount of experience relative to their business. Then it's just a matter of relationship, right? Who do I think I'm going to work the best with? Who do I think is going to put in the extra hours and cut their salaries first when things get tough? Who are going to make the tough decisions? And that's something that's very hard to predict when you're doing diligence on a company, but that's kind of going to be the make or break between any option.
I mean, what you like to see in a pitch? There are so different ways to pitch a venture capitalist, but the reality is, if you go wrong with a pitch, it's very difficult to move forward. So, what actually a pitch must have for to convince you?
Yeah, it's an interesting question. I might maybe want to dispel that a little bit. Like, we look at a pitch as like an SAT, where you do it once, and an SAT, you look at it as a kind of, you have to perfect it and get it done right, or else you're not making money, you're not getting any investment. I'll tell you a story. We met a company. This is a few years ago, and the pitch was absolutely horrible. One of the worst I've ever heard. The content was dense. The presenter wasn't good. The CEO and founder didn't present it very well. It took him like 10 minutes just to get to the product. It's like what he's actually doing. Everything was just preamble. And I just look, and I was pretty junior at the time. And I'm just like, oh my God, it's like, what are we doing here, man? Just like get to the thing. What are you doing? Like, what's your business? And even the pitch wasn't that good. Like, it was, you had to take a few layers away. And I remember asking him, like, okay, I don't know, like, I didn't pay attention to most of it because it was so boring. And I asked him, okay, what's your traction? And he gave me a number, and I was like, oh my God, there's like something real here. It's like, that forced me to spend more time learning about it. And the guy was a really good guy, and very credible and very humble and honest and transparent. So all those factors, and I was trying to get money into that business. We failed because we got out competed by somebody else. But I would have, and still today I regret not finding a way to make that deal work. So I would say to those that are worried about their pitch, obviously you have to do it right. So obviously important to have a good pitch and to do it well, but it's not the end of the world. If you have a good business at the end and you're a great entrepreneur, ultimately that's what's going to make the difference, right? You can have a great pitch and have the opposite, and it's not going to matter, right?
That's
Like
true.
if you're not a credible entrepreneur and you have a great pitch, nobody's gonna invest. So
Absolutely. I mean, how founders should approach venture capitalists? I mean, many times they really mass mailing, mass messaging everywhere, and maybe someone will come up. But if there is any way to get correctly in touch with the founder, what can be?
so
Sorry for with investors. Sorry.
it's the job of a venture capital person, whatever, to find great entrepreneurs that they are supposed to invest in that fits within their mandate, right? So I think that one of the mistakes founders make is that VCs are don't want to speak with them. They do. That like that's their job. That's like the primary thing that a VC will tell their investors is I have access to the great founders, the best founders out there. Like that's their whole pitch. Because if you don't have that, then it doesn't matter what you're like. Then what are you doing? you know. So the challenge that founders have, and maybe why they're not finding success with getting in front of VCs, is that they're not finding the VCs that fit their mandate, or they're not finding the VCs that would invest in their type of business. So that stage of the business, its industry, its type. If you find a firm that's supposed to invest in your type of business, then reach out to them, send them an email. The best way to do it is to get an actual warm introduction, obviously. But again, if they're looking for someone like you, then it's going to be easy because you're going to be connected through someone, right? So I would say don't worry about it. Have a concise email if you're doing cold reach out with a good pitch deck, and you'll get a very high response rate if they're looking for your type of business. And I think that's where most people fall because we see 5,000 companies. We get pitched or get inbound or outbound of 5,000 companies a year,
Wow.
right? Yeah, I mean, we're very effective. We go to a lot of events. We have a good funnel, right? Um, and most people, like, I don't know, I'd say 80% of those companies, 80% of the companies that reach out to us, it's not 80% of the total, 80% of the companies that reach out to us unsolicited, um, are not a fit at all. They're not like not a fit because they're below the revenue threshold. Like it's a consumer product. And on our website, it says we invest in B2B software. It's like, you can look at our website, I get pitched a lot of stuff that's like someone's selling me a factory in like Tashkent or something. It's like, come on, man, this is not, this is not what we do. Like, you're not going to find success that way.
They must do some homework.
Yeah. It's come on. And then they send the email where, you see the different type of fonts. They're copying and pasting from different things. They're not even sending an email to you. It's like your name. It's a different font than the rest of the
Yeah,
body of the
it's
email.
copy and paste, right?
Yeah, it's like but you put some effort. Show that you actually thought about it. You're reaching out because you think it's a good fit. Tell us why you think it's a good fit.
I know.
And I respond to all of them. The only ones I don't respond to are the ones that are clearly scams. But otherwise, I'm responding, and if I'm asked the reason why we don't think it's a good fit, I'll give you a reason, right? So that's most VCs are like that. So I think that just do the research on the people you reach out to, and you'll get a high hit rate of response.
You invest in B2B software where IP is that important, or mostly IP is very important when it comes to hardware, but when it comes to software, not that much really. So do you invest in startup without any intellectual property? But probably yes. But my question is, do you invest in startup where the technology is fully outsourced? Because many founders, they really outsource everything, 100%.
When you say outsource, you mean like the product development?
Yeah, correct. The
It's a
tech.
good question. It's a good question because if I'm on the board of a company and they say, "Hey, we can outsource a lot of the software development and save 50% of the cost," and you get, let's say, the same quality, right? Why wouldn't you do it?
Absolutely.
But when you're doing diligence, you want to know that the real question isn't so much who's doing the product development, right? It's what is unique about what you're doing that you can't be easily replicated. So if you can really replicate what the product is by just hiring some offshore development personnel in 6 months and then maybe a few $100,000, then you don't really have a protectable business. So what I've seen that works very well is when you have like an R&D lead or a product lead or something where it's just exceptional people. You're paying them good salaries and they're usually local to where the company is based. and then you're hiring out very specific roles, outsource to save money, for example, because they need to do something very specific. You don't need to pay more than you have to for that, right? It's rational to find the same quality but the cheapest price. It's really the innovative stuff that require like a serious R&D type personnel where you want to say, hey, we're differentiated because we do something so sophisticated and so innovative that only someone like him and maybe 20 other people like him can do, or her, or whatever. That's the kind of story you want to tell your investors. It also has to be true, right? Because then you're going to be, if there's a significant problem you're solving and a lot of money to be made, then you're going to have tons and tons of competitors, right? Because if it's just as easy to develop your product and just hire some outsourced people, then you're going to have a very crowded market, right?
That's correct. Where do you see the money going in 2024? I mean, let's take away AI because it's all about AI now. But except for except for AI, uh, where are the sectors and industry where probably most of the money will go in venture capital this year?
Yeah. So AI, I look at it as a horizontal thing. AI will
Yeah,
be in every
correct.
and
Yeah.
everything. I think the foundation model bonanza is probably still going to happen a bit, but we can leave that for now. But that's a capital intensive game. I don't know how people make sense of those investments because you're essentially buying, you know, you're buying processing units, right? But leave that aside. Everything is going to have AI embedded into it. What I think the next iteration of this is going to be, and we're seeing that really, is kind of the other layers. You're talking about the fine tuning layers, and even that's already being commoditized. And then you're talking about the application layers. So, in the application layer is really where you can start to develop something very value add. So, you have the foundation model, you have the fine tuning, then you have how that now interacts with the business's customers or whatever industry that's in. Look a little bit different. So I think that's going to be very interesting going forward, and each vertical will have its own um, iteration of that. So healthcare will be very different than financial services, be very different than HR and all that kind of thing. One interesting development that is going to happen. It's already happening for many years, but it's more of an issue today. Is how you take data and normalize it, right? So in healthcare, for example, it's a big problem because in healthcare you have a lot of systems within one hospital. You have maybe 10 or 15 software systems, even more sometimes, right? And all those hospital and those different systems need to speak to one another, and when they speak to one another, if you want them to have the best healthcare possible, all that data needs to be normalized, right? Just to give you a small example, like how do you actually, and if you want to do AI on top of that, you have to have normalized data, to be able to ingest all that to train the models, right? So that's kind of where we see a lot of interesting innovations. It's infrastructure is the type of thing you don't see. It's not flashy. It exists always in the background. That's the kind of thing we like, and I think there's going to be a lot of interesting investment opportunities over the next few years.
Thank you, Matan. Uh, I would like to close with any advice you can give to all the founders watching today, because we do this for them. It is any advice to give to them when approaching, when they decide to go to venture capital, because not everyone, the reality is not all startups can ask money to venture capital because there are some kind of requirements that you need to match in anyway to go to venture capital. So there is any advice you can give to them so they don't waste money. We don't waste time. And time is even money.
Yeah, the first thing I would say is that before you even start, you have to ask yourself a few very crucial questions. Most people that go out there and raise money from VCs or try to, they shouldn't be. They should. Their business is not fundable. They're not fundable, and it's very harsh, but it's true. And it's better to understand what your business is before and making sure that you're the type of person and your business is the type of business that fits the venture model. And very few are. And there's certain questions one should ask themselves. For example, why you and why now, right? These are maybe a bit deep questions, like why you. What makes you so unique that you're going to be the one in 50, the one in 100 funded startups that are going to make it to make it big, right? And of course, you have to believe that that's going to be you in order to go raise money with confidence. But so once you've answered that and you are the type of person and your business is a type of business that should be raising venture capital, then you have to really develop a plan. You have to create a good pitch, good data room, especially depending no matter what size of business you're in. You have to develop a strong network, right? You have to basically go out there and pitch 100 times before you're going to get an investor, right? You have to be ready for that process. It's a long process, and the earlier you are in the business, the longer the fundraising is going to take. And before starting that, you have to be prepared. You have to again, and that's just get an advisor, get some help, read books, go online, whatever the case is. There's a lot of material and resources like what you do, right? You're giving advice to founders, and what this conversation is about. And on my LinkedIn, there's a bunch of articles I posted written by myself that go through some of these crucial questions: how to prepare for raising venture capital, the pitfalls you should avoid. Like it's all there's so many resources out there.
Matan, thank you so much for coming to the Investor Talk series. It's been a very, very great pleasure for me talking to you. There's so much insight here. It's been
Thank you,
extremely
Max.
helpful. Thank you.
It was quite a pleasure, and I hope that the listeners got something out of it.
That's a lot. We've been talking, covering so many topics. It's been an absolutely great podcast. Thank you so much.
Thanks.